So I shared some of the pros and cons of active investing. This is where you're really hands-on. You might be the landlord of the property, you own it personally. You're involved potentially in day-to-day. You could hire a property manager, but there is still some involvement. Today, I want to talk briefly about the pros and cons of passive investing. Nate and I have had the chance to do both. We've done both sides of the coin when it comes to real estate investing. We've been active investors, we still are. We also have done passive investing, we still are. And so I think there's really two great avenues for getting involved and owning property if you are interested, in going either route. So today I just want to briefly share some of the pros and cons of passive investing. This could be through a syndication. We've done some of those, and I'm currently working on one of those. This is a group investment where we pool resources. We have an operator on the ground that is running the property, and then we bring in limited partners that are investors in the deal, so they can come in and provide some money to get into the deal. But it's a very hands-off way of being involved, and so you still get a lot of the benefits of real estate, but not maybe all of the hassles that you would get on the active side. So a couple of pros that I'll mention. I did share this on social media, so feel free to check out the little picture that I shared there. But there's usually a lower cost of entry. It just depends on the deal. We've done deals that had, a $35,000 minimum, all the way up to some that have $100,000 minimum. So every deal is a little different. I've heard of some that even have $10,000 entry. Now, obviously, that's going to impact your returns. You're not going to see a huge amount of cash flow from a $10,000 passive investment. But it's a way to get in. If you want to invest in a different deal, you might be able to get in at a really low entry point. Again, it's very hands-off. There's not a lot of work involved day to day. Mainly, it's choosing the operator, it's choosing your partner, your sponsor in the deal, and partnering up with them. And so you really need to do your due diligence. There's a lot of questions you should be asking, and that's a video for another day. But you want to make sure you're partnering with the right person, because there's a lot of good marketers out there when it comes to raising capital for deals and these syndications, but not all of them are good operators. So I highly recommend taking your time, doing your due diligence, really getting to know the person that you're partnering with, the person that you're putting your money with. There is typically cash flow. Every deal is different. Some of our deals, we see monthly cash flow. Some of them are quarterly. Some of them start really small, if it's like a value add multifamily, while others are higher. This assisted living deal I'm working on right now has a higher cash flow. It's 7.5% in the first quarter. So that's, it's a lot stronger than some of the others I've seen. You are going to see appreciation on the property, just like most other real estate. It's held for typically 3 to 5 years. So over that time, you'll probably see some appreciation in value. It's giving you the chance to diversify. You might only be investing in the stock market right now. So getting into a deal like this gives you the chance to dip your toes into real estate and diversify your portfolio. There could be some tax benefits. That's probably going to be a video for another day as well. And I'm not a CPA, so definitely talk to your CPA about that. And then, you're able to invest in a market that you might not normally be able to get into. For example, we have invested in Glendale, Arizona, which is in the Phoenix market. We really don't know that market very well, but we were able to get into that deal last year, and it's doing pretty well. And so that's something that, we have boots on the ground, people that know that market extremely well. We got that. It's an off-market deal, multifamily property, 120 units that we got into. And it's something, again, that it was a value add. There's some small value add components to it, and it's cash flowing already, which is nice. And so, every deal is a little bit different, but it gets you the chance, it gets you into markets, again, that you might not really know much about. You're not going to go visit on a regular basis. One other thing I'll mention is just leveraging the knowledge of experienced investors. Again, you don't have to know as much, because you're trusting the operator to really work the property, to be involved in the day-to-day operations and manage it, where you don't have to do that. Some of the cons, we just talked about the pros. Some of the cons is that you do not have control of day-to-day management. So if you're a very controlling person, this might not be the right route for you. You are not going to be sitting in those asset management calls and knowing exactly what's going on every day. Now, hopefully you'll get monthly or quarterly updates. That's what we send out, but you're not going to be able to have a say in those decisions. So that's something that's very important to keep in mind. You could have lower returns than active investing. Again, this is kind of deal specific. There's a lot more that goes into this, so I'm not going to spend a lot of time here, but it just depends on the deal. Your returns could be a little lower. Your principal's not secure. Every investment has its risk. So I think this kind of goes across the board that you might lose your principal at the end of the day. Ultimately, that's the biggest risk that you would be associating with. Whereas if you buy your own property, you've got a whole lot of money tied up into one property, and that property goes under, you would lose that whole property. You would probably really have a big hit on your credit. Your tenants, there's a lot of implications with one single property. Whereas if you invested, let's say 25,000 into a deal, that deal goes under, you're going to lose your principal, but it's not going to hit your credit. You're not signing on the loan. So that's something to keep in mind. It's not quite as risky from that standpoint outside of your initial principal. And then lastly, sponsors do charge fees. And so, they need to get paid for their work. It's typically not a lot, but I would definitely be paying attention to that. There's a lot of work that goes into finding deals and putting them together, going to visit them, managing them day to day. There's acquisition fees, there's asset management fees. And so you should be finding out what they're charging. They need to keep the lights on. They need to pay their employees. But just find that out and know that there is typically a 1 or 2% fee involved on those deals that they're putting together. So that's a look at the pros and cons of passive investing. I hope this is helpful, but feel free to reach out if you have any questions.